Hello, this is Jordan, and this video is being recorded on the afternoon of Tuesday, January 21st, 2020. Thank you so much for joining me today. And in this video, I'm going to discuss prospect generators, and I'm going to tell you the one time you should actually buy them or seriously consider buying them. Now, first, let's start off talking about the prospect generator model within junior exploration, which some companies use. And the concept of a prospect generator from a company standpoint is to really diversify your risk. So instead of making one big bet on a single project or asset, what they do in this model is to basically sell your interest out of whatever properties or projects they have or acquire or stake, sell those out, joint venture them out to other companies. And so essentially, you're making small bets or a small bet on a handful of projects. And overall, that limits the dilution in your share structure because with the normal model, if you keep working on a project for 5, 7 years, whatever, your share structure is obviously going to grow over time because you need to finance. So dilution is a major risk. So the big positive with this model is it limits your dilution. And in theory, it allows you to have patience and you're able to wait for a discovery because you've joint ventured out and still have an interest in a handful of properties or projects, that gives you lots of kicks at the can as far as making a potential discovery. Now, there's also numerous negatives to this model, which really don't get talked about all that often. The first is that there's no optionality here. If a prospect generator is early in its life or early in its work, there's no resource, or maybe maybe it only because it only owns usually around 30% of something, it only owns a fraction. So, if it owns 30% of something with 2 or 3 million ounces, it's 1 million ounces or less. It's not that much. So, there's really there's no leverage upside to a bull market. And secondly, the upside is limited because, as I said, usually, you see some deals where they own 49%, some where they own 21% or whatever. Usually in most cases, it tends to be around a third or 30%. So, even if a great discovery is made, they still only own 30% of that. For that to really work out, it has to be a really tiny company. And then if you're investing in the tiny company in the first place, it's a tiny company for a reason. It's a huge risk. And also, one thing that bothers me, what I've noticed a lot, is there's not enough drilling for most of these companies to really move the market. Too many times these joint ventures are very small deals where only $1 million or less gets spent every year. And that's just not that much money. If you joint venture something out and the company is spending, $3, $4, $5 million a year, that's significant. But again, in most of these cases, not a lot of money is being spent. So in that regard, there's lower odds of success. And the model is really sold as lower risk. Like, this is lower risk than investing in a typical junior. Well, that's not really true. The model is lower risk for the company, not the retail investor. It's lower risk for the company because they get to stay in their jobs and there's really no pressure on them to make a discovery. They can joint venture their projects out. They can also, as time goes on, they stake new properties and also joint venture those out. So they can just, if people say, well, you haven't done anything yet, you haven't made a discovery, they can say, it will work over time. We're going to continue to pursue this model. It will work. But again, that's low. The model is sold as lower risk for investors. It's not. It's lower risk for the company and the people inside the company because they can just pursue this model forever and stay in their jobs and not have to face the pressure of making a discovery and then moving that asset forward. Now, keep in mind, this niche is being promoted by people who finance these companies. So they get finder's fees. And when they finance these companies, they also get warrants. So the people who are selling this model to you as a retail investor, if a company does really well and it performs, you may make, let's say you make 3 or 4x on a success from a prospect generator because that person financed the company and has warrants. Maybe they make 7 or 8x, a lot more than you. So they can afford to be involved in more prospect generators than you or I can as a retail investor. So, and finally, the track record it's really not that great. It's really not that better than just the normal thing of looking for a company that goes all in on something. I haven't seen the evidence that it's really better. I've seen articles talking about how it's better, but those articles they leave out a lot of the companies that have been doing this for years and years and years and haven't even come close to making a discovery or really doing anything that's going to move the share price. So we have to look at these things from the standpoint of the retail investor. No, the model is not any better for the retail investor. But I mean, if you're on the side of the company, it's a better way to run the company because it's lower risk for you as far as your employment. You can stay there and just keep pursuing the model, staking projects, joint venturing them out, etc. You can just continue to do that. But with all that said, as you can tell, I'm not a huge fan of this model. But one thing, there actually is a time when you want to really get serious about buying a prospect generator or even buying it just outright. This is the key to remember with prospect generators, and this was told to me by an industry insider. The time to actually pay attention and buy a prospect generator is when it abandons the model. So it kind of abandons the model and it decides we have one project that's so good, it's so prospective, we don't want to joint venture this out. We're going to keep this for ourselves. We're going to keep 100% interest and drill it ourselves. That is the time when you want to look very hard and potentially buy a prospect generator. Because when they do that, as an investor that they think there's a reason they're keeping 100% of the project and not joint venturing it out. So, and actually something that's my top pick right now, I believe the company actually did this with its project. They've joint ventured everything else out. And actually, I actually like that model where you keep 100% of something and that's your focus, and then you joint venture everything else out that you're not that optimistic on. That's a little bit different of a model, but I actually like that compared to the model of we're just going to joint venture everything out and only own 30%. So I know I said a lot in this video. I hope this was educational and informative for you. If you'd like to follow more of my work, you can subscribe to my channel. Also, you can go to thedailygold.com, opt in there for my book, my free book, and consider subscribing to my premium newsletter. It's very affordable, and you can get that at thedailygold.com/premium. I thank you again for listening to and watching this video. I really appreciate it, and I look forward to publishing another update for you in the weeks ahead.